All right, let's go over some of the big myths regarding reverse mortgage. Who owns the house? You do, not the bank. What happens if you pass or there's a life event and there's equity remaining? Well, your heirs or your children get it. What happens if I'm upside down at a life event? FHA pays the difference. That was a add-on to the program way back in 1988. What happens if I don't pay? Well, nothing. So traditional mortgages, they can foreclose, or I should say, they typically begin the foreclosure process when you don't make three payments. With reverse mortgage, you never make a payment. So when you hear all this talk about, oh, they're going to foreclose, they're going to listen. The bank is going to foreclose on you regardless of what kind of mortgage you have. But the biggest difference, again, is reverse mortgage, you don't make payments, no principal and interest. Whereas a traditional mortgage, you do have to make payments. And if you miss three, then you're going to have a problem. Okay. So there's so many strategies that work so well, particularly with retirees. And I mean, this is a conversation that goes way beyond 3 minutes, okay? There's just so many things that you can use the reverse mortgage line of credit to work in tandem with your retirement strategy. And when you take withdrawals from your line of credit, it's not taxable because getting a loan is not a taxable event. Now, there are some other things that could make you have taxable events, such as using your line of credit to purchase investments that have capital gains. You really should talk to your CPA or financial planner. And by the way, they are getting on board right now more so than ever because they're starting to understand that it, in fact, is a very powerful program and the most heavily regulated loan product, perhaps. Reverse mortgages are safe, they're effective, and they serve a huge purpose for people just like you. DM me if you want to talk more.